Every single day, roughly $6.6 trillion changes hands across the global foreign exchange market. And of that staggering amount, nearly 90% of all transactions involve one currency, the United States dollar. The dollar is not just America's currency, it is the world's currency. It is how oil is priced, how global trade is settled, how central banks store their reserves, and how nations measure their economic strength. For over 80 years, the dollar has sat at the center of the global financial system, the one thing every country on earth agrees to trust. But that trust is beginning to crack, and the implications for the global economy, for the United States, and for your personal finances could be enormous. This is the story of how the US dollar became the most powerful currency in human history, why a growing coalition of nations is now working to replace it, and what it means for you if they succeed. It starts in 1944 in a small resort town in New Hampshire called Bretton Woods. With World War II still raging, 44 allied nations sent delegates to design a new global financial order. The old system, where currencies were backed by gold and exchange rates fluctuated wildly, had contributed to the Great Depression and, many believed, to the war itself. The solution they agreed on was revolutionary. Every major currency in the world would be pegged to the US dollar, and the dollar itself would be convertible to gold at $35 per ounce. The United States, which held roughly 75% of the world's gold reserves at the time, became the anchor of the entire system.
This arrangement gave the dollar an extraordinary privilege. Every country needed dollars to trade internationally. Every central bank needed dollars in its reserves. Every commodity, from oil to wheat to copper, was priced in dollars. It meant that the United States could print money and the entire world would absorb it. Economists called this the exorbitant privilege. The ability to borrow in your own currency at lower rates than anyone else, run massive trade deficits without consequence, and fund your military and social programs with money that other nations are essentially forced to lend you. For decades, this system worked. American consumers bought goods from around the world, sending dollars overseas. Foreign governments recycled those dollars by purchasing U.S. Treasury bonds, effectively lending the money back to America. It was a self-reinforcing loop that made the United States the indispensable economy. But in 1971, President Nixon did something that fundamentally changed the game. Facing pressure from rising inflation and a growing trade deficit, Nixon unilaterally ended the dollar's convertibility to gold, what became known as the Nixon shock. The dollar was no longer backed by anything physical. It was backed only by trust in the U.S. government, trust in the American economy, and trust in the institutions that managed it. And for 50 years, that trust held. Until now.
Here's what is happening right now. In 2023, the BRICS nations, Brazil, Russia, India, China, and South Africa, expanded their alliance to include Egypt, Ethiopia, Iran, and the UAE. Together, these nations represent over 40% of the world's population and roughly 36% of global GDP. And their stated goal is reducing dependence on the US dollar. China and Russia are already settling bilateral trade in yuan and rubles instead of dollars. Saudi Arabia, the cornerstone of the petrodollar system since the 1970s, has begun accepting yuan for oil sales to China. India is paying for Russian oil in rupees. Central banks around the world have been buying gold at the fastest pace in decades, over 1,000 tons per year, as a hedge against dollar exposure. The numbers tell the story. The dollar's share of global foreign exchange reserves has dropped from roughly 72% in 2000 to around 58% today. That is still dominant, but the trend line is unmistakable. The dollar is losing ground, slowly but steadily, and the pace is accelerating. Why is this happening? There are three major forces at work. First, weaponization. When Russia invaded Ukraine in 2022, the United States and its allies froze over $300 billion in Russian central bank reserves held in Western financial institutions. This sent a shockwave through every government on Earth. The message was clear. If you hold your reserves in dollars, the United States can seize them. For countries like China, India, and Saudi Arabia, this was a wake-up call. Why store your national wealth in a currency that can be weaponized against you? Second, debt. The United States national debt has surpassed $36 trillion, roughly 124% of GDP. The annual interest payments alone now exceed the entire defense budget. Foreign investors who hold U.S. Treasuries are asking a reasonable question. How long can this continue before the dollar's value erodes? Third, alternatives. For the first time in modern history, there are credible alternatives to the dollar system. China's yuan is now the fifth most traded currency globally. Digital currencies, including China's digital yuan, offer new mechanisms for cross-border settlement that bypass the traditional dollar-based SWIFT system entirely.
So, what does this mean for you? If the dollar loses its status as the world's reserve currency, even partially, the effects would ripple through every aspect of your financial life. Interest rates would rise. Without the built-in global demand for U.S. Treasury bonds, the government would have to offer higher yields to attract buyers. That means higher mortgage rates, higher car loan rates, higher credit card rates. Borrowing money would become significantly more expensive. Inflation would accelerate. The ability to import cheap goods from around the world depends partly on dollar strength. A weaker dollar means everything you buy from overseas, electronics, clothing, food ingredients, fuel, costs more. Your purchasing power shrinks. Investment returns would shift. The U.S. stock market has been the default destination for global capital. If that capital starts flowing elsewhere, toward Chinese markets, Indian markets, commodity-backed economies, American asset prices could stagnate while the rest of the world grows. But here is the important nuance. A full collapse of dollar dominance is not likely in the near term. There is simply no single currency ready to replace it. The yuan has capital controls that limit its usefulness. The euro has structural problems. Cryptocurrencies are too volatile. What is more likely is a gradual shift toward a multipolar currency world where the dollar remains important but shares the stage with 2 or 3 other major currencies. The smart move is not to panic, it is to prepare. Diversification is no longer optional. If your entire financial life is denominated in one currency, one stock market, one economy, you are making a bet, whether you realize it or not. And that bet is becoming riskier with every passing year. The dollar built the modern world, but the world is changing. And the question is no longer whether the dollar's dominance will fade, it is how fast, how far, and whether you will be ready when it does.